Ever wondered why some people seem to make money effortlessly while others struggle? It could all boil down to their investment strategies. In the world of finance, having a well-planned investment strategy is like having a compass in the wilderness. It guides your decisions, helping you navigate through market ups and downs, and can be instrumental in driving your wealth growth. So what are these investment strategies that can potentially transform your financial future? Let's dive in. Exchange-traded funds, or ETFs, are one of the most popular investment strategies today. These financial tools have revolutionized the investing world, but what exactly are they? Simply put, an ETF is a type of investment fund that is traded on stock exchanges, much like individual stocks. They're designed to track the performance of a specific index, sector, commodity, or asset. This means that when you buy shares in an ETF, you're essentially buying a small piece of a larger portfolio, which can include anything from the entire S&P 500 index to a specific industry sector, or even a single commodity like gold. One of the main advantages of ETFs is that they offer instant diversification. Instead of having to research and invest in each individual company within an index or sector, you can invest in a single ETF and gain exposure to a broad range of assets. This can significantly reduce the risk associated with investing in a single company or sector. Another benefit is the flexibility they offer. ETFs are traded throughout the day, just like individual stocks. This means you can buy or sell shares at any time during trading hours, providing you with greater control over your investment. But it's not all sunshine and rainbows. ETFs come with their own set of risks. For example, while they do offer diversification, this doesn't mean you're immune to market risk. If the market as a whole goes down, your ETF will likely follow suit. Additionally, not all ETFs are created equal. Some track their underlying index more accurately than others, and some have higher fees which can eat into your returns over time. Consider the success story of the SPDR S&P 500 ETF, one of the most widely traded ETFs in the world. It aims to replicate the performance of the S&P 500 index, and since its inception, it has provided investors with a low-cost, efficient way to invest in the broad U.S. stock market. But remember, past performance is not indicative of future results. ETFs offer a low-cost, efficient way to diversify your investment portfolio, but they are not without risks. So as with any investment, it's essential to do your homework before diving in. Stocks, the classic investment vehicle. But do you know how to make them work for you? Stocks, often referred to as shares, are units of ownership in a company. When you buy a company's stock, you're purchasing a piece of that company, a slice of the corporate pie, if you will. You're essentially betting on the company's future success. If the company does well, the price of the stock increases, and your investment grows. One of the primary benefits of investing in stocks is the potential for significant financial gain. For instance, let's take a look at the story of Apple Inc. If you had bought 100 shares of Apple in the late 1970s for around $200, those shares would be worth millions today. This is the magic of the stock market, the ability to share in the success of companies as they grow and prosper. But it's not all rainbows and unicorns. Investing in stocks also comes with risks. The stock market can be volatile, with prices fluctuating wildly from day to day based on a multitude of factors. If the company whose stock you own performs poorly or goes bankrupt, you could lose your investment. And then there's the challenge of choosing which stocks to invest in. There are thousands of companies listed on the stock market, each with its own unique prospects and risks. Making informed decisions requires careful research and analysis. Successful stock investing isn't just about picking winners, it's also about managing risk. This can be done by diversifying your portfolio, which means spreading your investments across a variety of stocks from different industries. Diversification can help protect you from the ups and downs of the market. So there you have it. Stocks offer the promise of significant returns, but they also come with substantial risks. To navigate these turbulent waters, you need to arm yourself with knowledge and a well-thought-out strategy. Investing in stocks can be profitable, but it requires careful research and risk management. Bonds, a safer harbor in the stormy seas of investment. But how effective are they really? Let's take a moment to break down this financial instrument that's as old as the hills but still as relevant as ever. Bonds, in essence, are loans that you give to an entity, be it a company or a government. You lend them money, and in return, they promise to pay you back with interest. This interest, or coupon as it's often called, is the reward for your trust in the borrower's ability to repay. Now, why would anyone want to buy bonds? Well, they come with a few enticing characteristics. First, they offer regular income in the form of fixed interest payments. Second, they are generally considered less volatile and therefore less risky than stocks. And third, in the event of a company's bankruptcy, bondholders are higher up in the pecking order than shareholders, meaning they're more likely to recoup their investment. But of course, bonds are not without their risks. The biggest one is credit risk, the risk that the borrower will default on its payments. Then there's interest rate risk, the risk that interest rates will rise, making your bond less attractive to other buyers. And let's not forget inflation risk, the risk that the purchasing power of your bond returns will be eroded by inflation. Despite these risks, bonds have proven to be successful investments for many. Take for instance the US Treasury bonds, which are considered to be one of the safest investments in the world. Their success lies in the trust that investors have in the US government's ability to repay its debts. Or consider corporate bonds from blue-chip companies. These bonds can offer higher returns than government bonds, and they come with the security of investing in well-established, financially stable companies. So, in conclusion, bonds can provide steady income and are less risky than stocks, but the returns are also generally lower. Like any investment, they come with their own set of risks and rewards. It's all about finding the right balance in your portfolio. Real estate, the investment you can touch and feel. But is it right for you? That's what we're here to explore today. When we talk about real estate, we're talking about an investment choice that's as old as the concept of land ownership. Investing in real estate involves the purchase, ownership, management, rental, or sale of real property for profit. But it's not just about buying a house and waiting for the price to go up. You can invest in everything from commercial properties and rental apartments to land development and real estate investment trusts. The appeal of real estate is quite straightforward. It's a tangible asset, something you can see and touch, unlike stocks or bonds. It provides a sense of security because it's always going to be there. You're investing in something real, something that has intrinsic value. Moreover, real estate can provide a consistent income stream if you choose to rent out your property. It can also offer tax advantages, such as depreciation. And over time, real estate has generally increased in value, providing a solid return on investment. But it's not all sunshine and rainbows. Real estate investment comes with its own set of risks. For starters, it requires a substantial upfront investment. Not everyone has the capital to purchase a property outright. Plus, real estate isn't a liquid asset. If you need to pull out your investment quickly, selling a property can be a lengthy and complex process. Then there's the ongoing management. Real estate requires maintenance, repairs, dealing with tenants if it's a rental property, and understanding and abiding by property laws. And let's not forget the potential for property values to decrease due to economic factors or natural disasters. Take the example of successful real estate investors like Robert Kiyosaki, author of Rich Dad, Poor Dad. He started with little and built a real estate empire, but it wasn't without risk, effort, and a deep understanding of the market. In conclusion, real estate can be a lucrative investment, but it requires a significant upfront investment and ongoing management. It's not for everyone, but for those who are up for the challenge, the rewards can be substantial. Investment strategies are as diverse as the investors themselves. We've embarked on a rich journey exploring the vast realm of investment options. Each strategy, unique in its approach, has a special role to play in shaping your financial future. Let's take a moment to revisit these strategies. We began with ETFs, those versatile powerhouses of diversification. Their ability to provide exposure to a wide range of assets makes them a compelling choice for many investors. Yet like every investment, they come with their share of risks. We then delved into the magic of the stock market. Buying shares in a company not only gives you a slice of ownership, but also a chance to participate in its growth story. But remember, the stock market is a roller coaster ride, and it's not for the faint-hearted. Our journey took us to the bond market next, a haven for those seeking stability and reliable income. Bonds, while generally safer than stocks, are not without their pitfalls. And let's not forget about tangible assets. Real estate and precious metals offer a sense of security in their tangibility, a comfort some investors find appealing, but they too, like all investments, carry risks. Remember, the best investment strategy is the one that aligns with your financial goals, risk tolerance, and investment horizon. So choose wisely and invest smartly.